Karibu sana to another session of Kurgat Eric Finance and Accountancy Tutorials. This is part 3 of the partnership accounts. I'm going systematic so that you get to understand this one, and I'm trying as much as possible to use simple language and to make sure that you at least you capture most of what is required of us from the partnership accounts. So ladies and gentlemen, in our previous session, part 2, we looked at the format of the profit and loss appropriation account. So today in this session we are going to look at the capital and the current accounts formats and the current account formats. But before we do that, if you are not subscribed to the channel, please do that and you share with as many friends as possible. Don't be mean, and give the video a thumbs up. It will give me that motivation to work extra hard to bring you good video tutorials. And you also make sure that you hit the notification bell so that you don't miss out on any video tutorial that maybe I'll share in future from now going forward. So without much ado, allow me to take you through the formats of capital and the current accounts. So when we are preparing, or when I was taking you through the format of the statement of financial position or the balance sheet of a sole trader, I did tell you that there is that part of financed by of the balance sheet, the financed by. You still remember the financed by? This is what was happening. We said that for the statement of financial position, we have the non-current assets, and then we have current assets, and then current liabilities, and then long-term liabilities, and then finally the financed by section. So if you are not conversant about the format of the statement of financial position, the link is on the comment section. It's there. I've put it there so that it takes you back to that place, and make sure that you rewind as many times as possible so that you get to understand the format. Format is very, very, very important in accounting. So IAS 1, remember IAS 1, the International Accounting Standards. IAS 1 talks about presentation of financial statements, and some of the presentation, what is required by IAS 1 is the structure of how you prepare the financial statements. Very important. So we said in the financed by section, we said we'll have maybe the business being financed by capital, and then maybe the owner, the sole trader, reduced the capital by drawing. We call it drawings, and you add net profit. If it's a loss, you say less net loss. Yes, if it's a profit, you add. If it's a loss, you less. But you cannot have the two at the same time, so you take one. So that is what was under the financed by of the balance sheet of a sole trader. So let me go to the capital and current account, and this is where I'm talking about the financed by section of the format of the statement of financial position. So let me start with capital account. So in partnership accounts, the capital is normally divided into two. Number one is fixed capital account and the fluctuating capital account. So what does it mean when you hear something is fixed? If something is fixed, means it doesn't change. There is no change, there is no that fluctuation, right? So if the capital account, for instance, if you say this is our capital account, yes, and then maybe you have the balance brought down of maybe 500 or 5,000 as such. Fixed capital account will mean that this capital account will not change irrespective of any changes, right? except when there is an additional capital that is going to be added, or if there is an amendment of the partnership deed. Are we together? So this capital account, if it's a fixed account, then it means nothing changes. Nothing changes. You just close this account as usual, and that is all. All the other changes are going to be catered for by what is known as the current account. Ladies and gentlemen, we've said in the financed by, yes, of a sole trader, what we have capital, yes, and then we less drawings, and then maybe we add net profit. So these are the books of, or rather the finance by section of a sole trader. So you can see it's very clear that the capital is changing. This year the capital, you've reduced some amount of drawings and then you've added. Next year it will change. It's kind of, the capital account of a sole trader is fluctuating. It's fluctuating, right? It's changing. It's not static. It's not fixed, right? So for fixed capital account, nothing is affecting. I mean, there is no issue of saying we are going to less drawings here. Yes, we are going to add net profit here. No, nothing. So here under fixed capital account, it remains as it is. Nothing changes. Yes, so to cater for those other changes like drawings, net profit, share of profit, interest on drawings, interest on capital and so forth, the profit share, then there will be need of opening an extra account known as the current account, so that to cater for those fluctuating, those other changes that are affecting the capital account, right? So this is what I mean. So for fixed account, you must have a capital account and a current account. Yes, so the current account will take or will handle all those other adjustments of capital, because the capital account in itself doesn't allow any change. It is fixed. So those other changes like reducing drawings, handing profits are going to be taken care of by the current account. I know that is where people had problems. The capital account, if it's fixed, then the current account will take those other adjustments on behalf of the capital account. So let me take you through the format of the current account. Now that you know the capital account, when it's fixed, the current account will take over the changes. Yes, that maybe will affect the capital account. So let me take you through the format of current account. Current account. Yes, so this is the format of the current account. You put 2 lines, and then maybe you have 2 partners. This is what will happen. We have 2 partners. So this is the column of particulars. And this, maybe you have partner A and partner B. This is a column of particulars. We have partner A and partner B. So just like the same case where we have in the capital account, you have balances brought down. This is more of capital account. This one also has got balances brought down. Yes, balance brought down. The balance brought down in most cases you'll find on the credit side, right? Yes, on the credit side. But don't be shocked to find an examination question where the balance of the current account is negative. Yes, you may find that the current account, if you are told the current account, we have partner A and B. Partner A is 50, and then partner B is negative 40. Negative 40 means it is not a capital, it is not a credit balance, it is a debit balance. It means that the partner overdrew his or her account, right? So don't be shocked to find that the current account will have a balance on this other side. So it can have a balance here. Let's say, for instance, balance brought down for partner, maybe partner A, partner B, yes, has this balance on this side. So it means this partner will not have the balance on that other side. A current account is a benefit account to the partners. Are we together? So the partners are going to benefit, and their benefits are recorded in the credit side, right? As you all know from our deal award, do you still remember the deal award? The deal award, where we said it's a word that maybe will guide you in telling you or to understand what to debit or to credit, what has the credit balance and what doesn't have the credit balance, and vice versa. So we said the capital accounts normally have credit balances, and increasing the capital accounts you increase on the credit side, and reducing the same you reduce on the debit side. So the benefits of the partner will come on the credit side. So let's assume not even assuming, from our trading profit and loss appropriation account, we have those things that we are adding to the profits, right? And the ones that we are reducing from the profits. So some of the benefits of the partner here are like the interest on capital, right? Yes, because the partnership organization is paying the partners interest of the capital that they had contributed. So you are going to add interest on capital. Yes, maybe that way. And then what you are going to add to the partners again is the profit sharing. Profit share. Maybe partner A received a certain profit, partner B the same case. So what I mean, these are this side of credit. This is the credit side, this is debit. This credit side of the current account records the benefits of the partner. And another benefit that maybe the partner could get is the salary. Maybe partner A was receiving salary, partner B was not, or either way. So you can say partner A was receiving salary, but not the two. Are we together? So another thing that you are going to include here is the interest on loan. So let us assume that partner B lend the partnership organization some amount of money in form of loan. Remember, if it's a loan, it means that the partnership business is going to pay interest on that loan, and the interest is a benefit to the partner. So that's why we are adding it where? Here. We are adding it to the partner. So let us assume that partner A, or rather partner B, is the one who gave out a loan to the business. So the interest on that loan is going to be enjoyed by that partner as such. Take note, this one I didn't tell you when I was giving you the format of profit and loss appropriation account. From the profit and loss appropriation account, you are not supposed to reduce the interest on loan, a loan that was provided by a member, when doing the appropriation. No. Remember, a loan is an operational issue. A loan is normally given by a person to the business for operational issues, right? So this partner is going to be treated not like a partner is giving out a loan, but just like somebody else who is giving out a loan to the business. That's why the interest on loan will not be seen or not be subtracted from in the profit and loss appropriation account, but it will be subtracted in the normal expense in the income and expenditure account before arriving at the net profit and loss that will be subjected to appropriation. Are we together? So interest on loan is treated as the normal expense in the income statement account before arriving at net profit and loss that is going to be appropriated in finding the residual profit for profit sharing with the partners. Are we together? So that's why, but I'm bringing it here in the current account because it's a benefit to the partner. We want to see the net worth of the partner at that particular period. And then we are supposed to reduce some items. Remember, these is a partner's account, a current account. So, but the partners have withdrawn some amount. So that one will reduce their balances of capital. So you say less drawings. Just the same way we said here, capital minus drawings. Are we together? So drawings, we are going to minus on this other side. Remember this one, we are acting on fixed account, where the capital account is fixed, no changes. So the changes will be taken care of by the current account that you are opening. So the changes is what we are doing. So maybe we say that partner A withdrew that much as such, right? And then there is that interest on these drawings now. Where will that go? Let us reason together. The interest on drawings is going to benefit the business organization, right? And that means it is going to reduce the partners' balances, because they are the partners paying the business, the partnership organization, and not the vice versa. So it means interest on drawings is going to reduce the value of, or rather the benefits of the partner. Are we together? So ladies and gentlemen, those are some of the adjustments that you'll find in the current account, and I want to believe I'm clear. So the balancing now, this is how to balance. So ladies and gentlemen, I did show you how to balance off the ledger accounts. This is more of a ledger account. It's like cash book, how you balance the cash book. So this is how to balance. You add all the figures here in A's column, the partner A's column, and you balance with the same partner's A column on the debit side. So whichever side is heavier. And also the same case applies to partner B. So in most cases, the balance carried down for partners' current accounts normally comes on the debit side. So that means directly opposite here, you will find balance brought down of a certain figure. Yes, so ladies and gentlemen, that is how to prepare the current account, and I want to believe I've captured as many things as possible, So, but when it comes to fluctuating, now that was all about fixed account on capital. Fixed account of capital, you must have a current account that we have opened to cater for those fluctuations in the capital. But if you have a fluctuating capital account, it is like this account here. So you just open an account on capital. If you are told that the partnership business maintains a fluctuating capital account, this is how it will look like. You just open the capital account comfortably, just like capital account as such, just like how we've done the current account, right? So just open it as such, put double lines in the middle to differentiate credit and debit side, and then you say you have partner A and B, as such. That is how it is. That's good. So the balances are normally on this side, balance brought down. Yes, and then you say you add. Now, in short, you are going to transfer what you have here in the current account to come here because it's fluctuating. There is no need of opening the current account if the capital account is fluctuating. All these adjustments will come here. In short, the current account will be converted to be the capital account because you are going to add interest on capital, profit share, salaries, and so forth. You reduce the drawings and interest on drawings and so forth. Are we together? So look here in the capital account. In our profit and loss appropriation account, we had interest on capital. We did the profit share, still in the profit and loss appropriation. We did the issue of salaries, we paid salaries, and also interest, but we did not see the interest on loan, sorry. The interest on loan, okay, we checked on interest on drawings, but not drawings. So what we've added here in the current account, and it is not in the profit and loss appropriation accounts, are only two: the interest on loan and the drawings. And I told you the reason as to why the interest on loan will not be found in the profit and loss appropriation account, right? Yes, you just less it as an expense, normal expense in the income statement before arriving at the net profit. Yes, so ladies and gentlemen, I want to believe that I have done justice to the current and capital accounts, and also the profit and loss appropriation accounts. So in our next session, ladies and gentlemen, we are going to take a question, a comprehensive question that is going to cover most of what we've done here today. So until that time, make sure you subscribe. Make sure you subscribe and you share with as many friends as possible. So bye. See you then.